Welcome to Commerce and Accounting, where we dive deep into the conceptual understanding of accounting. Today, we will begin our journey into journal entries, a fundamental concept in accounting that serves as the foundation for financial record-keeping. Whether you are a commerce student or an accounting professional, this session will help you develop a strong understanding of the underlying principles behind journal entries. A journal entry is the primary recording of financial transactions in the accounting system. It serves as the foundation for all subsequent accounting processes and financial reporting. Without accurate journal entries, a business cannot maintain reliable financial records. Every business transaction must be recorded in a structured and systematic way to ensure accuracy and reliability in financial reporting. This means that each transaction, no matter how small, needs to be documented with precision. The process helps in tracking the financial health of the business and aids in making informed decisions. A journal entry records the date of the transaction, the accounts involved in the transaction, the debit and credit amounts, and a brief narration explaining the transaction. This detailed recording ensures that every financial activity is traceable and verifiable. The date helps in chronological tracking, while the narration provides context for future reference. This process follows the double-entry accounting system, where each transaction impacts at least two accounts. One is debited, and the other is credited. This system ensures that the accounting equation, assets equal liabilities plus equity, always remains balanced. By doing so, it provides a comprehensive view of the financial state of the business, highlighting both the sources and uses of funds. Journal entries are crucial for preparing financial statements such as the balance sheet, income statement, and cash flow statement. These statements are essential for stakeholders, including investors, creditors, and management, to assess the financial performance and position of the business. Properly maintained journal entries ensure that these financial statements are accurate and reliable. Double-entry accounting is based on the principle that every financial transaction affects two or more accounts to maintain the balance of the accounting equation. Assets equal liabilities plus equity. For every debit entry, there must be an equal and corresponding credit entry. This ensures that the books remain balanced. A journal entry consists of the following key components: the date, account title and explanation, debit amount, and credit amount. These elements are crucial for maintaining accurate financial records and ensuring that every transaction is properly documented. The date indicates when the transaction occurred, which is essential for chronological tracking. The account title and explanation provide a brief description of the transaction, making it easier to understand the nature of the entry. The debit and credit amounts show the financial impact on the respective accounts, following the double-entry accounting system. For example, on the 1st of March, 2025, the office supplies account is debited 10,000 rupees and the accounts payable account is credited 10,000 rupees. This transaction reflects the purchase of office supplies on credit. By debiting the office supplies account, we acknowledge an increase in assets, while crediting the accounts payable account recognizes an increase in liabilities. This method ensures that the accounting equation remains balanced. The narration explains the transaction clearly. Purchased office supplies on credit. This description helps anyone reviewing the journal entry to quickly understand the nature of the transaction without needing to delve into further details. It is a concise way to communicate the essence of the transaction. The office supplies account is an asset account, and it increases, so it is debited. In accounting, assets are resources owned by the business that are expected to bring future economic benefits. By debiting the office supplies account, we are recording the acquisition of these supplies, which will be used in the business operations. The accounts payable account is a liability account, and it increases, so it is credited. Liabilities represent obligations that the business needs to settle in the future. By crediting the accounts payable account, we are acknowledging that the business now owes money to the supplier for the office supplies purchased on credit. The narration explains the transaction clearly. Understanding the structure of a journal entry is fundamental for anyone involved in accounting or bookkeeping. It ensures that financial records are accurate, complete, and easy to interpret, which is essential for making informed business decisions. To properly record transactions, we follow the golden rules of accounting, which are categorized into three types of accounts. A. Real account, assets. The rule is, debit what comes in, credit what goes out. B. Personal account, individuals and companies. The rule is, debit the receiver, credit the giver. C. Nominal account, income and expenses. The rule is, debit all expenses and losses, credit all incomes and gains. By applying these rules, we ensure that each transaction is recorded accurately according to its nature. Let's take examples of real-world businesses and their journal entries to understand how companies record transactions in their books. Example 1. Tata Motors. Purchase of raw materials. Tata Motors purchases steel worth 5 lakh rupees on credit from JSW Steel. Date 10th March 2025. Account title and explanation: raw materials account, debit 5 lakh rupees, credit E, to JSW Steel account, debit E, credit 5 lakh rupees, purchase steel on credit. Example 2. Reliance Industries, sale of goods. Reliance Industries sells petroleum products worth 10 lakh rupees to Indian Oil Corporation on credit. Date 15th March 2025. Account title and explanation: accounts receivable, Indian Oil, debit 10 lakh rupees. To sales revenue account, credit 10 lakh rupees, sold petroleum products on credit. Example 3. Infosys employee salary payment. Infosys pays 50 lakh rupees as salaries to its employees. Date 31st March 2025. Account title and explanation: salaries expense account, debit 50 lakh rupees. To bank account, credit 50 lakh rupees. Paid employee salaries for March. These examples illustrate how major corporations record financial transactions using journal entries. Journal entries serve as the backbone of accounting because they provide a chronological record of all financial transactions. They help in preparing financial statements like the trial balance, profit and loss account, and balance sheet. They maintain transparency and accuracy in financial reporting, and they facilitate audit trails for verification and compliance. Understanding journal entries is crucial for accurate financial recording. These entries form the backbone of your financial statements, ensuring that every transaction is accurately captured and categorized. Without a solid grasp of journal entries, it becomes challenging to maintain the integrity of your financial data and decision-making. This is just the beginning of our deep dive into the world of accounting. As you continue to learn and apply these concepts, you'll find that your ability to analyze and interpret financial information will significantly improve. This knowledge is not only essential for accountants but also for business owners, managers, and anyone involved in financial planning. In the next session, we will explore types of journal entries and common transaction examples with more practical scenarios. We'll delve into the specifics of how different transactions are recorded, from simple cash sales to more complex accruals and deferrals. By the end of the next session, you'll have a comprehensive understanding of how to handle various financial events in your journal entries. Call to action. If you found this session valuable, give it a thumbs up. Your feedback helps us understand what content resonates with you and allows us to tailor future sessions to better meet your needs. Share it with your friends, colleagues, or anyone who might benefit from this knowledge. Sharing is a great way to spread valuable information and help others improve their financial literacy. And subscribe to our channel for more in-depth accounting knowledge. By subscribing, you'll be the first to know when we release new content, ensuring you never miss an update. Comment below with any doubts or questions you may have. We love hearing from our viewers and are here to help you on your accounting journey, or topics you want us to cover next. Your suggestions are invaluable in helping us create content that is relevant and useful to you. Stay tuned for the next episode where we take journal entries to the next level. We look forward to continuing this journey with you and helping you master the art of accounting.